The AI bubble is about to burst, and investors in tech-oriented ETFs from VGT and XLK to JEPQ and QYLD to even VOO and SPY are going to get crushed. If you're new to fundamentals of finance, you should know that I don't do clickbait or fear-mongering videos. And unlike most finance YouTubers, I'm actually an investment professional and CFA Charterholder. That's not a guarantee that I'll be right, and this is not investment advice. But if you have a lot of money in US stocks, you're going to want to hear this. First, we're going to cover why AI is a bubble, then why that bubble is going to pop, why the downturn is going to be worse than you think, and then which investments I think could do best and worst in that environment. Let's start with why AI is in a bubble. Bubbles always start with a legitimate long-term investment case. Could AI really change the world in the long run? Absolutely. The internet did too, but that was still a bubble in the 90s. High potential returns attract investors, which leads to higher returns, which attracts more investors. The media hops on the train, and eventually it becomes consensus. Once everyone has the same view, people take it for granted that it must be right. That conveys an element of safety and complacency, which causes investors to take on more and more risk, often without even realizing it. All of that is happening here. I have never seen anything in the market so one-sided in my entire investment career. Let me give you an example. In FactSet, they compile ratings from 61 different analysts who cover NVIDIA, which is widely seen as the #1 AI beneficiary. Guess how many of those analysts have sell recommendations on NVIDIA? Not a single one. Think about that for a second. Name one other topic anywhere in life where you could ask 61 different people their opinions about it and they would all agree. I mean, statistically, 6 out of every 61 people think the freaking earth is flat. This is insane, and it will not end well. Another indication that we're in a bubble is that stock prices are being massively influenced by perception about whether a company is on the wrong or right side of this trend. And companies are gaming the system to try to play into that. In the most recent quarter, over 200 companies in the S&P 500 mentioned AI on their earnings calls. There are not 200 AI companies in the S&P 500. This is a chart of NICE, which is a software company. These stock swings are basically the market saying, NICE is an AI loser. Oh wait, actually no, they're an AI winner. Oh, hold on, never mind, they're an AI loser after all. Then they had a CEO change and it dropped further. But I'm seeing this kind of thing all over the place. And it's basically the same thing that happened in the internet bubble. This is a chart of G3 Apparel, which makes leather goods. At the end of 1998, their stock went up like 500% in a couple days because they issued a press release that said they were going to start selling their products over the internet. There was just one problem. They didn't actually have a plan for how to do that. The market was just latching on to anything related to the internet at that time. Fast forward to the end of 2023, and Alphabet rallies on the release of its Gemini AI. Granted, it was more like 5% than 500%, but there was still one problem. The product really wasn't ready for prime time, and they had to fake their release video. A 5% increase may not sound like a lot, but for Alphabet, that was about an $80 to $100 billion increase in the value of the company. Was there any indication that Gemini's release would generate that much profit? Obviously not. AI headlines are driving stocks, just like internet headlines were driving stocks in the 1990s. The third indication that this is a bubble is that it's starting to break things. Up until the internet came out, people generally wanted to invest in companies that actually earned a profit, or at least had a plan for how they would eventually. What a novel concept, right? But in the internet bubble, people thought the internet would be so big that near-term profits just didn't matter anymore. And they started valuing companies on price to sales instead of price to earnings, because, of course, most of those companies had no earnings. It broke the valuation metric that had worked forever, except that it wasn't actually broken. It was just telling people what they didn't want to hear, that they shouldn't only be buying tech stocks. But instead of listening to it, they changed the rules to justify their position. Similar things are happening today. First, in 2023, the NASDAQ, aka QQQ, had to do a special rebalance because a few US tech companies had gotten too concentrated, even for the NASDAQ, which is usually pretty concentrated. Then, more recently, Morningstar announced that they'll be reworking their style boxes because major index funds like VOO and SPY have basically become growth funds. People tout the diversification of VOO, for example, but this is showing that it's really not that diversified anymore. The 10 largest US stocks right now are all growth stocks, all 10 of them, and they make up 40% of the market as Morningstar defines it, which is the most concentrated it's ever been. When things start to break, and companies or investors start making adjustments to their process or to established rules to fit the current narrative, rather than considering the idea that the narrative might be wrong, that's a huge sign of a bubble. The final point I'll make to show that this is a bubble is that everyone has invested in it, and both the risk and concentration have increased massively. In a lot of cases, people don't even realize they're taking on all this risk. This is also classic bubble behavior. In the internet bubble, a lot of conservative dividend paying growth and income funds were going like 50+% tech, which of course was not conservative and mostly didn't pay dividend either back then. In real estate in the mid 2000s, they thought real estate could never lose value, so they lowered lending standards and banks started taking on way more mortgage risk because they didn't see it as a risk. Fast forward to today, then you not only have supposedly diversified indexes like the S&P 500 and Russell 1000 leaning toward growth and investing over 30% of their assets in tech, which means investors in things like VOO and IWB are making a big bet without realizing it. But worse than that, you have investors in covered call ETFs like JEPQ, QYLD, FEPI, the Yield Max ETFs, and others that are all making concentrated bets on the same things, often with a false promise of downside protection. It's important to differentiate here. If you're young and you're investing in a tech ETF like VGT because you think it has great long-term upside, that's fine. I might be wrong. If I'm right, and you're wrong, and it goes down 40%, whatever. You've got time to recover. You're young. However, I think retirees that rely on these tech-oriented covered call ETFs for income are in a very different situation. Even though they should go down less than tech in a tech downturn, they're still likely to go down a lot. And unlike young investors in a tech ETF, retirees are not young, and these covered call ETFs will not recover quickly as a typical tech ETF, especially if investors are taking out the income. This could absolutely devastate people who are relying on these things for income in retirement. If it's a 5% position, whatever. If you're reinvesting the income, still not ideal, but probably fine in the long run. If you're taking the income and relying on these, I fear that could be a very big mistake that would be really hard to come back from. Just over the past month, we can already see how much downside risk some of these have. In a period of about 3 weeks, QYLD fell 8%, JEPQ fell 10%, and FEPI fell 13%. This is with dividends reinvested. And FEPI actually did even worse than QQQ, which only fell 12%. If that's not proof, then I don't know what would be. This brings us to section 2, why this bubble is going to pop. Bubbles pop when consensus finally changes. Bubbles are, by definition, irrational, so you can never really predict exactly when they will pop. If you pay attention, you can usually see it coming. Usually what happens is, along the way, companies invest too much in the new technology, people invest too much in the stocks, and then when the consensus sure thing turns out to be too good to be true, it all comes crashing down. We tend to overestimate the effect of a technology in the short run and underestimate its effect in the long run. This has been common all through history with new technologies. It happened with the telegraph, railroads, electric lighting, but in fear that I might lose you by giving you an example from the 1800s, let's talk about fiber optic cables. In the late 1990s, they projected that internet usage was doubling every 3 months. Based on that projection, telecom companies started spending tons of money in a race to lay down fiber optic cables underneath the roads, oceans, etc., to build out the infrastructure of the internet and make sure they weren't left behind. There was just one problem. Their projected adoption rate was way off. 3 years later, only 2.7% of the cables they'd laid down were actually being used, and most of the companies that spent all that money went bankrupt. These were two of the big telecom funds at the time. They more than tripled from 1997 to 2000, then gave it all back by mid-2002. Fast forward to today, you have charts like this one that show ChatGPT reaching 1 million users in just 5 days, faster than anything before. Wow, what could be next? How big could it be? How fast could it grow? Sound familiar? Just like with fiber optic cables, that's led to a huge amount of investment, this time in data centers, by companies who wanted to control the infrastructure. Again, this time with AI. Sound familiar? Earlier this year, NVIDIA's CEO said he expects data center spending to double to $2 trillion. That's about 5 times the combined profits of all the Magnificent Seven stocks over the past year. Where is this money going to come from? And if that spending projection is anywhere near correct, which I actually don't think it is, where would all the profits come from to justify all that spending? Here's a quote from a friend of mine who's building a data center for one of these companies right now. If AI is overhyped, there will be a massive amount of money set on fire by FANG. He's right. And that brings us to why I think the bubble is getting close to bursting. There's a huge gap between the AI revenue that would be required to justify all of these investments and the actual amount potential customers are planning to spend. Putting aside the wildly optimistic estimate from NVIDIA's CEO for a moment, the 5 big tech firms, Microsoft, Meta, Alphabet, Amazon, and Apple, have seen their market caps, which is basically the value of the company, increase by over $2.3 trillion over the past year. A rough estimate, based on their profit margins, would equate that to investor expectations of about $300 to $400 billion more in annual revenues. Obviously, AI is not their only source of revenue growth, but it is a huge part of the hype that's driven these stock prices up. When you look at actual analyst projections for AI revenue at these companies, it's not even remotely close to that, even for the most optimistic estimates. The Census Bureau did a recent study showing that only 5% of businesses use AI in producing goods or services. That's a solid black line. And only about 7% plan to use it in the next 6 months. That's a solid gray line. That lines up with data from the U.S. Bureau of Economic Analysis, which shows that businesses only plan to spend about 5% more on computers and software this year than last year, adjusted for inflation, which is actually a slower growth rate than the long-term average. So if companies aren't planning to buy these AI products, where is all the profit going to come from to justify all the spending to develop them? Here's how I think this will play out. Just like we've seen in pretty much every investment bubble surrounding a major new world-changing technology, I think at some point it will become apparent that AI is going to be more of an evolution than a revolution. These big tech companies are all highly profitable. They have strong established businesses. So I don't think they're all going to go bankrupt like the telecom companies and a lot of internet companies in the early 2000s. But I do think a painful period of adjusted expectations is pretty likely. I think the first domino to fall will be big tech companies pulling back AI-related investments like building data centers and or cutting their revenue and profit forecasts. I think that when they do that, it will reverberate through the entire supply chain. All the companies that design and make semiconductors, build servers, provide clean energy, make cooling systems, and so forth and so on, that have seen their stock prices rocket due to AI-related optimism, would all be in for a downward adjustment. If the big tech companies don't spend as much, the companies further down the supply chain don't make as much. If we weren't in a bubble, I don't think that would be anything more than a cyclical downturn, which every industry goes through from time to time. However, the bubble-like conditions we've had over the past couple of years have led to a confluence of other factors that lead me to believe that this correction could be much sharper than most people expect. That brings us to section 3. 5 reasons a downturn could be worse than expected. Bubbles grow when a combination of hype and a false sense of certainty lead to consensus, and then greater concentration and risk-taking. The more influences point in the same direction, the bigger the bubble will get, and the bigger the bubble gets, the harder it will pop. Here are 5 seemingly unrelated factors that are all piling on top of each other to grow the bubble much bigger than it seems on the surface. Number 1, the rise of passive. Everyone is going passive right now. This is important because passive indexes, for the most part, are market cap weighted, meaning they invest the most in the biggest companies. For every dollar that goes into the most popular passive funds like VOO, the company that manages it in this case Vanguard, has to invest more and more money in the biggest stocks. That drives the stocks higher, and they become even bigger parts of the indexes, which gives them an even bigger slice of future investments into index funds. And it drives the stocks even higher, and it becomes a self-fulfilling prophecy. This is important because it has the opposite impact on the largest companies when the money is going out of the indexes. Recently, it's all been one way. Flows into passive U.S. large blend funds like VOO and SPY have skyrocketed over the past 10 years, taking in over $1 trillion in inflows, all being invested almost exactly the same way. The growth rate has picked up even more since 2021, and through the first 7 months, it's on pace for another record year in 2024. But that's only half the story. Well, actually, more like a quarter of the story. At the same time, the percentage of these funds invested in tech has also doubled. So, without even realizing it, people have been making a bigger and bigger bet on US tech, which is increasingly dominated by just a few companies. Then, there's an even stronger trend in passive large growth funds, which would be where your tech heavy ETFs like QQQ, VUG, and IWF would fall. Those have seen a similar pattern and stepped up buying in the last 3 years, and an even more pronounced bet being made this year, on pace to nearly triple its previous record through the first 7 months of 2024. And just like the blend category, these have also grown a lot more tech heavy over time, from 27% in 2014 to 39% today. By the way, if you thought those concentration numbers sounded big, you should know that 4 of the Magnificent 7 companies, Amazon, Meta, aka Facebook, Alphabet, aka Google, and Tesla, don't even count as tech. Meta and Alphabet used to count as tech, but they changed the definition in 2018 to move a bunch of companies to other sectors, which is why you see that drop in 2019. If you were to count those companies, tech concentration would be significantly higher in both supposedly diversified ETFs like VOO and growth-oriented ones like QQQ. It only gets worse from here. The second factor is people that definitely know they're making a big bet on tech. Dedicated tech ETFs have already taken in over $19 billion in the first 7 months of this year. The only other times they've taken in $20 billion in a full year were 1999 and 2000, right before the crash from 2000 to 2002, and then again in 2020, right before the crash in late 2021 and 2022. Average investors do not historically have good timing. If they're all making the same concentrated bet, that should raise some eyebrows. On top of that, we've had a massive surge in flows into tech-covered call ETFs. The derivative income category, where QYLD, XYLD, JEPI, and JEPQ sit, has grown over 13x in size over the past 4 years. More than 75% of the funds in the category didn't exist 5 years ago. 2/3 didn't even exist 3 years ago, and almost half did not exist 1 year ago. This is a frenzy. It's chasing the hot dollar. It's a huge sign that the end is near. This is the part that concerns me the most, not because it will have the biggest impact on the crash, but because it's these investors who will be hurt the most. These investors are equivalent of people in 2005 to 2007 who had no income but thought they could get rich flipping houses, then ended up filing for bankruptcy when it all came crashing down. They got into something that they didn't understand, took on way more risk than they thought they were taking on, and it led to a devastating outcome that was hard to come back from. In the mid-2000s, that was real estate investing, leveraged house flipping because they thought houses never went down, and then bankruptcy. The last few years, it's been covered call ETFs, which make concentrated bets on tech because they think it will never go down, and the outcome is TBD. What I think will happen is these tech-oriented ones like JEPQ, QYLD, and FEPI will provide minimal downside protection in a short, quick tech crash. The only downside protection they really provide is from the call premiums, which are usually around 1 to 2% per month. In a long-term gradual decline, they would provide protection. In a short, sharp one, not so much. But then, since they're selling call options and giving up most of the upside potential, whenever tech does swing back and recover, they will barely participate. Investors could easily be left with 20+% losses in a short period of time, And if they're relying on these for income and retirement, they're probably going to have some very tough decisions to make, like going back to work or choosing which bills not to pay. I may or may not be right that this tech crash will happen, but I am 100% right that it is a real risk. And in my opinion, no retiree should be taking it. The fourth area of concentrated bets on AI and tech is the rise in AI cryptocurrencies. To be honest, I don't have a dang clue what any of these do, but when basically every altcoin ever launched has failed, and an unknown category of them goes from 1 billion to 40 billion in a year and a half, that's another massive red flag. The final area, which could easily be the biggest of all, is the Japanese carry trade. No one really knows how big this is, and the estimates out there are all over the place, so I won't waste your time giving you mine. But it's already caused a huge spike down in early August, and pretty much no one out there actually thinks it's done. Essentially, what happened was that Japan had very low rates, often below 0%, for the past decade. That led large investors like hedge funds to borrow a lot of money in yen since they were barely paying any interest on those loans. They took the money they borrowed and used it to buy things with better return potential. This could be treasury bonds, US tech stocks, or basically anything. They make money when other assets go up, and they also make money when the Japanese yen weakens, since a weakening yen basically reduces the amount they owe on their loan in dollar terms. That's what's been happening. No one really knows how much of this went into US tech stocks, but we do know that it was a lot because of what happened on August 5th. For more detail, you can go watch our recent yen video. But in short, three factors came together at once to lead investors to believe that 1. Japanese rates would go up, and 2. US rates would go down. When they get closer together, the yen strengthens and the carry trade starts losing money. Large investors started unwinding this trade, meaning they were selling their other assets, like US tech stocks, and buying Japanese yen to pay back their loans. That caused other assets to go down and the Japanese yen to go up. As soon as this trade looks like it's not going to work anymore, either because tech starts to fall or US and Japanese rates start to get closer together, this is likely to unwind. You know what's really likely to happen in the next few years? The US cutting interest rates. And that could be a catalyst for this whole house of cards coming down. But regardless of what starts the downturn in tech, whenever it happens, the unwinding of all this leverage is likely to enhance the losses, maybe significantly, in a short period of time. Early August was just an appetizer. We definitely haven't had the full meal yet. There's a lot more to come. And that brings us to the final section, the best and worst investment opportunities in this scenario. Let's start with the worst. This is admittedly an obvious one. Everything tech heavy. I don't care if it's a tech ETF, tech crypto, tech covered call ETF, a growth ETF, a momentum ETF, a NASDAQ ETF, an S&P 500 ETF, or any other flavor of a bet on tech. There are a lot of them. We've covered a lot here, not even all of them. If you own any of these and you think you're not betting on tech and AI, you're fooling yourself. That's like saying, I'm not eating cookies, I'm eating cookie dough. I'm not eating cookies, I'm eating flour, sugar, and chocolate chips. They may look different, but they're all more or less the same thing. I'm not saying that you should sell all your US equities. In fact, I'm not telling you to do anything. As a reminder, nothing in this video is advice. But what I am saying is that lots of people are making concentrated bets on the same thing. And I would not want to be one of those people right now. For some historical context, let's say that we're not close to the top, but there will be a downturn eventually. Even if these companies are the long-term winners, which is far from certain, they could still be terrible investments from here. If you had bought Apple 50% before its peak in 1999, you would have felt pretty smart. You would have said, this guy Ethan who said tech is going to crash is an idiot. Look at all this money I'm making. But a year later, you would have lost all your gains and much more. And it would have taken about 5 years just to get back to even. And that was actually the least bad example. If you bought Amazon, it would have taken you over 8 years to recover. If you bought Microsoft, it would have taken over 15 years to recover. If you just bought the hot index QQQ, it would have taken almost 14 years. This isn't from the peak. This is from 50% below the peak. You started with a 50% return and you still got crushed. Sure, this situation isn't exactly the same as any prior bubble, and history doesn't always repeat itself, but it does often rhyme, and those who don't know market history are doomed to repeat it. But I think that's enough doom and gloom for now, so here are 4 opportunities I like in this environment, and some that might work out even if I'm wrong. Number 1 is the Japanese yen. Obviously, this is not something you'd put your whole portfolio in, but what I like about it is that there's a path for it to do well, even if I'm wrong. Like I said earlier, and explained more in depth in our yen video, the yen is likely to go up when the US starts cutting rates. It would likely go up much faster if and when the yen carry trade unwinds. But even if that doesn't happen, and even if the US doesn't cut rates as fast as people think, which actually I don't think they will, eventually, the US will very likely cut rates a lot, and the yen would likely strengthen a lot in that case. The added bonus is that if there's a surprise US recession, that would cause US rates to fall faster and also likely boost the yen quite a bit. There's a lot of ways this can work out, which is why I made it number 1. How would it fail? Rising rates in the US and a continued tech rally and no recession. Technically possible, but in my opinion, highly unlikely over the next couple of years. Personally, I'm invested in this through a 2x yen ETF, ticker YCL. Numbers 2 through 4, in no particular order, are small caps, value/defensive/dividend payers, and international. I think a reversal of this trade will send money into all the things that have been out of favor, which are these areas. Small caps are a bit of a wild card, but very attractive in the long run, in my opinion. We'll get to that in a second. Right now, small caps are extremely cheap compared to large caps, in part because large caps have had so much hype-related buying, and in part because small caps have been hurt more by rising interest rates. If I'm wrong about this tech crash, I think the setup is really nice for them over the next few years. And in the long term, I like them because usually, with new technological advancements, the early winners are the enablers of technology, and the long-term winners are the users of the technology. With the internet, that was internet providers like AOL, search like Yahoo, and internet enabling hardware companies like Cisco, which made routers, modems, and stuff like that. Eventually, AOL blew up because dial-up internet was replaced by broadband. Yahoo blew up because Google came up with a better search function, and Cisco kind of just plodded along, failing to innovate into the next era. Its stock price is still below its peak from the year 2000. Within AI, just like the internet, the infrastructure providers are seen as the biggest beneficiaries right now. Those are, for example, the semiconductor companies like NVIDIA and the companies building large language models like Alphabet and Microsoft. Will those companies still be seen as the winners in 10 years? I don't know. It worked for Google and Amazon, but it didn't work for most of them. What I am confident in is that a lot of the biggest long-term winners from AI are not in the Magnificent Seven, and we probably haven't heard about most of them. They may not even exist yet. But a good small cap fund is the most likely place to find them and get in early. The reason I said small caps were a bit of a wild card earlier is that I'm expecting a stock market downturn, and small caps usually don't do well in stock market downturns. This one might be unique if it's led by the largest companies, but I still wouldn't expect small caps to hold up well if the market is down 20%. Currently, small caps are my largest position, but I'm leaving room to make them much larger if there's a short-term downturn for some reason. The first of my 2 favorite ways to invest in small caps is American Fund's Small Cap World Fund, which is the first ticker there. It's global, which I like. It has incredible long-term track record, and if there's any fund I would trust to find the long-term AI winners, it would be this one. My other favorite is TNA, a 3x leveraged small cap ETF. Now, obviously, this is not for everyone, and it's something I trim when it goes up a lot, not a long-term buy and hold in my opinion. But I still thought I'd mention it here since I own a lot of it. And third, not one I own, but if you wanted to marry small caps and value, which we're about to talk about, a solid way to do that would be through DFSV, the DFA US Small Cap Value ETF. I like value and international for more or less the same reason. They're what's been really out of favor, they don't have much tech or AI exposure, and I expect that's where a lot of money would go if it left the concentrated US tech bets. Within value, I like CGDV, Capital Group Dividend Value ETF. Or if you prefer a passive option, I think SCHD is a solid one. We've done a video comparing them that goes into a lot more detail. Both of these come with the added benefit that they typically hold up better than the overall market in downturns. And if this downturn is driven by US tech, I would expect they'd hold up especially well in that scenario. Within international, I like CGXU, CGIE, and BINV. CJXU is my overall long term favorite, and CGIE actually aims to hold up well in downturns, but both have a lot of semiconductor exposure right now, which could hurt them in this scenario. BINV is more value oriented international, which could hold up best in the bursting of an AI bubble. We did a full video breaking down all the top international ETFs to complement VOO, so if you haven't seen it, I'd highly recommend checking that out. Let's take a look back at the signs of a bubble. High prices? Yep. US tech has been crushing everything else, and valuations are definitely stretched. Whether you compare it to bonds or value stocks or international stocks or small cap stocks, valuations of US tech stocks are a massive outlier versus history right now. So much so that they're breaking things like the Morningstar Style Box and the QQQ ETF. Excessive leverage? Yep. We had a whole section about that and the rise of passive, Japan carry trade, and so forth and so on. Increased speculative activity? Absolutely. On pace to nearly triple the all-time previous high in tech ETF inflows, and tens of billions of dollars pouring into random AI altcoins. Definitely some increased speculative activity. How about popular stories? Yep. Remember the examples of NICE's stock price going for wild swings based on AI love and hate? And remember Alphabet's stock price rallying when they released their chatbot that was so bad they had to fake their intro video? And FOMO? Oh, yeah. Even retired income investors are finding ways to juice up their yields with tech. And we talked about all the fund launches in that space. Almost 50% weren't even around a year ago. And the rise of AI altcoins, everyone wants a piece of the action. Like I said earlier, bubbles are, by definition, irrational. So you can't ever predict precisely when they will pop. But if you pay attention, you can get a pretty good idea that they will eventually. All the signs are there. And if we think about what's required to make all these investments pay off, it's just totally unrealistic, in my opinion. AI tools would need to improve way faster. Businesses would need to spend hundreds of billions of dollars per year adopting them, which they currently say they have no plans to do. We didn't even talk about how AI tools have already used most of the data on the internet and are expected to run out by 2028, so they might not be able to improve so fast. We didn't even talk about the possible regulatory challenges or all the lawsuits against AI companies for copyright infringement. At some point, one way or another, this is very likely to all come crashing down. Big tech companies, their whole supply chain, and every investor making concentrated bets on those things will face a reckoning, and the excess leverage in the system will make it much worse. That doesn't mean that the Magnificent Seven companies are all going bankrupt. It's the tech bubble, and most of them are very profitable. It also doesn't mean that AI won't eventually change the world and create a lot of great investment opportunities. It just means that this really feels like a bubble. Investors have made a lot of concentrated bets, and I think there's going to be a painful adjustment period for those people who don't take their opportunity to sell high and diversify. If you made it this far, thank you so much for watching. This is probably the longest video we've ever done, and it took us about 20 to 30 hours to put it together, so we really hope you found it helpful. If you did, hit that subscribe button, and we'll hope to see you back soon for some hopefully much shorter but equally insightful videos. If you want to continue the conversation, let us know what you thought in the comments section, and come join us in our free Discord through the link in the description. We'll look forward to seeing you in the next one.